For most people, your home is the biggest purchase you are ever going to make. That's why you want to make sure you're getting a mortgage the right way. And in this video, I'm going to be going over everything you need to know about getting a mortgage the right way. What's up, everybody? I'm Jasprit Singh from theminoritymindset.com, where money minds rethink rich. Buying a home is exciting and it's a big deal, but the process isn't always straightforward. You got to deal with real estate agents, bankers, title companies, property inspectors, and because homes are so expensive, if you don't know what you're doing, you could end up way overpaying. I've seen real estate from a lot of different angles because I used to be a real estate agent, I'm a real estate investor, and I'm an attorney. Now, I'm not gonna go over the steps on how to actually buy a home in this video. I already made a video on YouTube where I went over how to do that exactly. If you wanna watch that video, I will link it for you in the description below. But in this video, I wanna go over the things you need to understand about getting a mortgage. If you wanna buy a $400,000 home, chances are you don't got 400 grand just sitting at the bank that you can use to buy the home. So you're gonna work at the bank to get a mortgage, that way you can actually buy the home, but you wanna make sure you're not getting taken advantage of by your bank. There's 5 things you wanna make sure you understand when you're getting a mortgage, and I'm gonna go over all 5 of these things in this video, so make sure you watch this video until the end. But before I get into that, I need you to do me a quick favor and mortgage that thumbs up button below. Before you go out and actually start looking at homes and making an offer, the first thing you wanna do is get pre-qualified and get prepared to actually getting a mortgage. All getting pre-qualified means is that you've worked with a lender or a banker to get the basic credit process done. That way the bank or lender can see if they're willing to give you a loan. If you're not pre-qualified, you don't look like a serious buyer. Because I can tell you from personal experience, it is a major headache working with somebody who's not pre-qualified, because if you fall in love with a home and you put an offer and it gets accepted, and now you have to kind of get pre-qualified and get approved to get a mortgage, and you can't do that, it is a major hassle because now you're wasting your time, you're wasting your real estate agent's time, and you're wasting the seller's time. I was selling an apartment complex that I was a part owner of, and a lady brought an offer to me. The problem was she was not pre-qualified, but she gave me a pretty good offer. Now, the real estate agent I was working with kept saying, "Oh, don't worry, Jasprit, she has a lot of money, she's really successful, she'll have no problem getting a loan." So I thought, okay, fine, I'll let this one go. So now we're in contract. I take my property off market, and a month goes by, she couldn't get approved for a loan. 2 months go by, she couldn't get approved for a loan. 4 months go by, and she could not get approved for a loan. At this point, we had to cancel the deal, and I had taken the property off market for 4 months, and it was just a huge waste of time on my part, on my real estate agent's part, and her part. As soon as you get pre-qualified, you automatically have an edge over other buyers who are not pre-qualified, because if I'm selling a home and I get 2 offers, one is from somebody who's pre-qualified and one is from somebody who's not pre-qualified, and you're pre-qualified and your offer is slightly lower than this person's, I'm still gonna take your offer even though it's less money, because it's less headache and less uncertainty because you've already gotten pre-qualified. Part of the pre-qualification process is you getting prepared to actually get a mortgage because, well, getting a mortgage is kind of a difficult process. You're essentially kind of selling yourself to the bank, and you want to show the bank why you're a good investment for their money, because if you can show the bank that you're a good investment, they will reward you with a lower interest rate. First, you got to show the bank your proof of income. So you might need to show your tax returns, your W-2s, your 1099s, whatever income that you have at least for 2 years steadily. You need to show this to the bank, that way the bank can see that you're making money consistently. Second, you want to show the bank any assets you might have. So maybe you own some real estate investments or stock market investments or other assets. You want to show this to the bank so you can show the bank what you have. Third, the bank is going to want to know what debt you have and how much debt you have. Your debt to income ratio is literally just a fraction, where banks look at how much debt you're making and they divide it by your income. So nowadays, banks typically like to see a debt to income ratio of less than 36%. So they want to see that your debt is less than 36% of your income, and out of this 36%, they typically don't want to see more than 28% for your mortgage. So this is how much your mortgage should be max, and the rest of it can be your credit card debt, your car loans, or whatever. This is how much banks ideally want to see, but sometimes you'll see banks stretch this total debt to income ratio from 36% up to 43%. So if you have a lot of outstanding debt, credit card debt, car loans, it's going to be harder for you to qualify for a mortgage. So you need to work right now to pay down that debt. That way you can lower your debt to income ratio. The 5th thing your bank or lender is going to look at is your credit score. You can get approved for a mortgage with a credit score of 620 or higher, but if you have a 620 credit score, score, you're going to have to pay a lot more fees and a lot higher interest rate because the bank's going to look at you like a riskier investment. If you want to get the best interest rates and not pay these extra fees, you want to have a credit score of at least 760 or above. If you're looking for ways to boost your credit score, you can use a credit card strategically and you can work to pay your bills on time. If you want to learn more about how to actually boost your credit score, I'm not going to go over that in this video, but our team wrote an article on how to do that on our website, theminoritymindset.com, and I'll link it for you in the description below. The second thing you need to understand about mortgages are the different kinds of mortgages out there, because not all mortgages are created the same. First, let's talk about the differences between a fixed rate mortgage and an adjustable rate mortgage, an ARM. So fixed rate mortgages are very straightforward. If you go to the bank and tell them you want a loan, they might say, all right, this mortgage is going to cost you 2.8% a year, and if you agree to that for the next 30 years, you're going to be paying 2.8% a year in interest on your mortgage, and that's it. It's not going to change. Whether interest rates go up or down, this is the interest rate you are going to pay, and you have a set monthly payment. With an adjustable rate mortgage, it's not like that. With an ARM, the amount of money you're going to pay on your mortgage is going to change depending on what interest rates are. So one type of ARM that became very popular during the 2008 crash was the 228 ARM. What that means is during the first 2 years of your mortgage, you're going to have a very low introductory teaser interest rate. So during the first 2 years, your monthly mortgage payments are very low. Then after that, your interest rate is going to change every 2 years depending on what interest rates are. So if interest rates go up, then your mortgage payments are going to go up, and that's going to change every 2 years for the next 30 years. So you don't know what your mortgage payment is going to look like in 5 years or 10 years because you don't know what interest rates are going to be. If interest rates go up, your mortgage payments can go up. Another example of this is the 5-to-1 ARM. What this means is during the first 5 years of your mortgage, your interest rate is fixed, and then every year, every 1 year after that, your mortgage rate is going to change depending on what interest rates are. And then the 5-by-5 ARM says that during the first 5 years of your mortgage, your interest rate is not going to change, but then every 5 years after that, your interest rate is going to change depending on what interest rates are. ARMs can be good when you're in an interest rate environment where you think interest rates are going to go down. But right now, we are in one of the lowest interest rate periods in history. It doesn't make sense to get an ARM when interest rates are already lower than they've ever been. In the future, the only way interest rates can go are up unless we go negative interest rates. But even then, we're already seeing the lowest interest rates in history, and we saw what happens if you tie yourself into an ARM and then interest rates go up, because that's exactly what happened in the 2008 crash. Everybody was getting into these 228 ARMs thinking that they were getting this amazing low teaser rate for the first couple of years, and then real estate prices came down and people couldn't refinance, and now everybody's mortgage payments were way higher than they anticipated, so people started foreclosing left and right. So ARMs can be good, hypothetically, when you're in an interest rate environment where interest rates are going down, but they come with their own fair share of risk. You can mitigate that risk just by getting a low fixed rate mortgage, and now you know exactly what your mortgage payments are going to be for the entire length of your mortgage. You have two main categories of mortgages. You have conventional mortgages, and then you have government mortgages. Government mortgages is money coming from the government, and conventional mortgages are not. That's the main difference. But the way these different types of mortgages play out is a little bit different when it comes to your down payment and how high your interest rate is going to be, so you really want to understand the differences. So starting with the conventional mortgage, you have a couple of different kinds. You have conforming mortgages, and then you have non-conforming mortgages. All the difference is how big your mortgage is. Fannie Mae and Freddie Mac set what the limit is for a conforming mortgage, and if you get a mortgage that's bigger than that, it's called a non-conforming mortgage, and then you need something called a jumbo loan. So the difference between these two types of mortgages is really just how big your mortgage is. In 2021, the limit for a conforming mortgage is right around $550,000 for your mortgage, unless you're in a really big city like New York, where now your mortgage limit is a little bit higher. But if you get a mortgage that's smaller than that, you will get a conforming mortgage. If you need a mortgage that's bigger than that, then you're going to need a non-conforming jumbo loan. If you qualify for a conventional conforming mortgage, then you can get a home with a down payment as small as 3%. Now, if you put down 3%, you're going to have to pay additional fees like PMI, which is private mortgage insurance, where you're essentially buying insurance for the bank just in case you foreclose. But just understand that you can buy a home with a low down payment. However, it's going to cost you a little bit more in fees. With a non-conforming mortgage, so if you're getting a larger loan, a jumbo loan, then you're not going to typically get a down payment that's as small as 3%. You're going to have to pay a larger down payment because the bank is risking more money on you. So they're going to want you to put more skin in the game. Once you have 20% equity in your home, or if you put down 20% equity when you buy the home, then you can wipe out PMI. So until you have 20% equity in your home, you're going to be paying that additional fee called PMI with a conventional mortgage. And the advantage with a conventional mortgage over government-based mortgages is typically you get a lower interest rate here because you have a higher credit score requirement. So it's a little bit more difficult to qualify for a conventional mortgage than it is for a government mortgage. Now, moving on to government mortgages, the first type of mortgage is the FHA mortgage. So FHA is the Federal Housing Association, and the whole point of these FHA mortgages is to help people qualify for a home and mortgage who don't have the best credit score and who might not be able to put down a lot of money as a down payment. So to qualify for an FHA mortgage, you need to only have 3.5% as a down payment, and you can qualify for an FHA mortgage in some instances with a credit score lower than 620. Now, the downfall with this is FHA mortgages come with higher interest rates and higher fees. So because lenders will kind of look at you more as a risky investment, you're going to have to pay the price. And so one thing you're going to have to do is you're going to have to pay an upfront insurance fee when you get an FHA mortgage. And then you're going to have to pay an insurance fee on the back end for the life of your mortgage. So it's not PMI like you have to pay here. It's a different type of insurance, but you have to pay this additional fee in addition to your regular mortgage payments just because you're getting an FHA mortgage. The difference between the insurance fee that you have to pay with an FHA mortgage every single month and this PMI that you have to pay here if you don't have 20% in equity in your home is once you have 20% equity in your home with an FHA mortgage, you have to keep paying that fee. So this fee doesn't go away once you have 20% equity versus PMI goes away here once you have 20% equity. So the whole idea is these government mortgages can help you get a home, and then once you can qualify for a conventional mortgage, you can refinance out here and get one of these. That way you can pay a lower interest rate and pay less in fees. Second is the USDA, United States Department of Agriculture loans. These are more for rural homes. This is for people who are lower income or moderate income. This allows you to buy a home with 0% down payment in certain instances. So you can buy a home with nothing down, but again, you got to pay higher fees. You're going to have to pay another insurance fee with your mortgage here, and that does not go away once you have 20% equity. So once you have 20% equity, it might make sense for you to refinance and get another loan here, depending on what interest rates are. And third are your VA loans. This is for military personnel and people who were in the military. So VA loans let you qualify for mortgages with 0% down, and these can be typically lower interest rate mortgages. However, because you're getting a lower interest rate and because you're putting 0% down, you have to pay a higher upfront fee here, an insurance fee with the VA mortgage, than you see here or here. So to qualify for a VA mortgage, you have to be a part of the military or have been a part of the military, and then you have to pay that additional fee in the beginning. But with the VA loan, unlike FHA and USDA, you don't have that ongoing insurance fee. So these government mortgages can help you qualify for a home, but with an FHA and USDA mortgage, you might have to pay higher fees during the life of your mortgage. So it might make sense for you to then refinance into a conventional mortgage, again depending on what interest rates are when you're looking at refinancing, because then you can save some money on your interest rate mortgage and you might not have to pay some of these insurance fees. Third, you got to understand what changes your mortgage rates. There are 5 big factors that affect your interest rates, and we've gone over 4 of them. So one of them is whether you're getting a fixed rate or an adjustable rate mortgage. Second is what interest rates are. These are set by the Federal Reserve Bank. Third is how much your credit score is. Fourth is how much money you're putting down. And fifth is how long your mortgage is. To understand this, you really got to look at it from the perspective of the bank. So banks have all this money, and when they loan this money out, it is an investment for the bank. So the riskier the investment is for the bank, the more money they're going to want to see as a return. So if you're asking for a risky loan, the bank is going to want to charge you more money. And one of the ways to qualify a riskier investment is how long you want to borrow the money for. The longer the bank has to go without their money, the riskier the investment is. And so when you compare a 15-year mortgage with a 30-year mortgage, a 30-year mortgage is going to seem a little bit riskier for the bank because their money is going to be with you for 30 years. And so the bank is going to charge you a little bit higher in interest. With a 15-year mortgage, the bank is going to get their money back in 15 years, not 30 years. And so they can charge you a little bit less in interest because it's less risky for the bank. This is where you have to make more of a personal financial decision, because when you get a 30-year mortgage, you can buy a bigger home and have a smaller monthly payment because your payments are extended over 30 years instead of just over 15 years. So if you look at the same mortgage over 30 years or 15 years, your 15-year mortgage is going to have a lower interest rate, but your monthly payments are going to be higher because you have to pay the mortgage off within 15 years. If you extend it over 30 years, your monthly payment is naturally going to be smaller, so you can qualify for more home. One thing that that you can also do to help you with your mortgage rate is just shop around. It's crazy how many people don't do this. They just go to the bank that they normally go to for their mortgage without shopping around. Some lenders are going to charge you a whole lot less in interest for the exact same mortgage. So it is in your best interest to shop around and make sure you're getting the lowest interest rate on your mortgage. There's really no excuse not to shop around anymore because you can shop around on the internet for your mortgage and it only takes a few minutes. If you want to learn more about how to do that, our team put together an amazing guide that walks you through how to get the best interest rate on your mortgage or refinance. So if you want to learn more about how to do that, I will link the article for you in the description below. Fourth, when it comes to getting a mortgage, it is your job to know what you can afford. It is not your real estate agent's job and it is not your bank's job. Your real estate agent's job is in the business of selling you a home. Your banker's job is in the business of selling you a mortgage. It is in both of these parties' best interest to give you the best home, which is typically the biggest home, which is also the home that's going to give these two parties the biggest commission check. Now, your job is to know what you can afford for your wallet. Just because you can qualify for $1 million home doesn't mean that you can afford it, and it doesn't mean that you should buy it. It's funny, every time I say this, I get these kind of angry messages from bankers or real estate people because I'm telling you to buy what you can afford, not buy what you can qualify for, and so that's not good news for the real estate agent or the banker. But let me show you what I mean. When it comes to affording a home, there's two things you have to look at. You have to look at the down payment and then the monthly payment. Your real estate agent and your banker's job is to get you into the home. So they're going to do whatever they can and pull whatever strings they can to get you into a home, even if you can't necessarily afford it. So when it comes to the down payment, a lot of times they're going to try to push you into a home with 0 to 5% down. That way you can get into that home of your dreams. Now, just because you can get into a home with 0% down or 5% down does not mean that you can afford it. If you really want to be able to afford your home, you want to be putting down 20%. Now, I know that's a lot of money. You want to buy a $300,000 home, that's $60,000 in cash you got to put down. But if you really want to be able to afford a home, you need to be putting down 20%. When you put down 20%, now you don't have to pay the higher fees, you don't have to pay the higher interest rates, and you have more equity in your home. When it comes to your mortgage payment, your monthly payment, your bank is going to say that they want your monthly payment to be something like 28% of your gross take-home pay. So this is before taxes. So if you take your total take-home pay before taxes, 28% of that should be your mortgage. I don't want you to pay that much money towards your mortgage because then on top of that, you got to pay your taxes, you got to pay all of your other bills, your utility bills, your car payments, everything else. I don't want you to do that. So what I want you to do is I want your monthly payment to be 25% of your actual take-home pay. So you take the money you're making, you pay your taxes, and now out of what's left, 1/4 should be the maximum of how much you're paying towards your mortgage. When you do that, you will leave enough money for your savings and for your investments. That way you can work to build yourself wealth instead of having all of your money going into the bank to make the bank rich. I want you to use your money to make yourself rich by paying a maximum of 25% of your take-home pay to your bank and then using as much as you can to invest and save in your own wealth. Now, I know this might mean you might have to work a little bit harder to own a home, you might have to buy a little bit smaller home, and you might have to save more money for your down payment. But you are going to sleep a whole lot easier knowing you're not stretching yourself too thin to buy this dream home that you can't even afford. Now, you're using your money the right way, that way you can make yourself rich instead of just your banker richer. The fifth thing that you have to understand when it comes to getting a mortgage is you might potentially want to refinance out of your mortgage in the future. So I mentioned this a little bit earlier in this video. If you get a government mortgage, you might have to pay a little bit higher interest rates and you might have to pay additional insurance on your mortgage. Now, if interest rates come down and you build more equity in your home, you could use this as an opportunity to refinance into a lower interest rate mortgage and to get rid of some of these fees. That way now you have the home that you're still living in and all you see happen is your monthly payments drop because you have a better mortgage now. The thing that I want to remind you here, that in order to refinance your mortgage, you need to see property values stay the same or go up. But real estate prices don't always go up. So you want to keep that in mind. Because people who were buying homes in the early 2000s, they were buying homes with these low teaser rates, thinking that when interest rates go up, they'll just be able to refinance their mortgage and then get these lower interest rates. The problem was that home prices dropped. So when people went to refinance their mortgages, turns out they couldn't qualify for a new refinance because they didn't have any equity in the homes because their home values dropped. So yeah, refinancing can be a great tool if you can refinance into a lower interest rate mortgage. But you don't want to go into a home thinking, yeah, you know what, I'll make the sacrifice now. That way in 5 years I can refinance into a better mortgage. You don't want to do that because there's no way to predict what the world or what the real estate market or what the housing market is going to look like in 5 years. You don't want to be in that position that people were in back in 2008 and 2009. If you do want to see how to refinance your mortgage and save the most money, the article I linked in the description below walks you through how to do that. But what I'm trying to say is this is why it's so important for you to be able to afford the home that you're buying right now, because you don't want to run in a situation where 5-10 years down the road, home prices drop or you can't refinance because you thought you were going to be able to, and now you're stuck in a home that you cannot afford. Make sure you can afford the home today and not kind of rely on the stars to align in the future so you can afford the home. If you enjoyed this video, here's a video on how to buy a home that I think you'll love. And while you're at it, subscribe to our YouTube channel and join our free finance and business newsletter. And as always, keep hustling. Like 9 out of 10 millennials say that they want to be homeowners. But unlike what your cousin Bunty says, buying a home the right way isn't so simple. If it was, you wouldn't have so many home buyers regretting their decisions.